Good morning. This is Jim Barlow with OakTree Premium Finance. Hope everyone is doing well. A little later in the month, we were out of town quite a bit than I usually do my webinars, but here we are. Today, we're going to talk about what is premium finance and how does it work. You know, it's in the name, OakTree Premium Finance. This is our primary thing, is where well, let's get to the next slide. We'll answer the questions as we go for sure. Okay, so what is premium finance? Let's reverse the words. Finance premiums. That's what we do. We finance premiums of life insurance. Let's just read this statement. Premium finance is a strategy where individuals leverage cash value life insurance policies by borrowing funds to pay all or part of life insurance premiums. This approach is similar to taking a mortgage on your home. You borrow money to afford a larger home than your current cash reserves would allow, or you tie up less in the property, enabling you to control more property and other assets. In premium finance, you borrow funds to invest more into life insurance, resulting in increased policy value benefits. The loan is typically collateralized by investors' liquid assets. The foremost goal is to buy sufficient life insurance to pay the estate tax at estate owner's death. We can use premium finance for other reasons, but this is the number one reason that people use premium finance. And I've got a great example that I think will be really helpful. First, we partner, I believe, with the best, a company in Plano, Texas, NIW companies. They don't want to just sell something. They want to sell something that works really well. And these are foremost experts in premium finance. So that's why I partner with them. Their persistency, 95% and higher of policies stay in place, the highest in the industry. They've helped finance $6 billion of loans. Strong connections with loan companies, 25 years of experience. They have 30 employees, half are dedicated to client service. This is all these things are important to me. NIW is also the parent company of Kaizen, which is my first and foremost product. If you want to call Kaizen Premium Finance Junior, you could, or you could call hybrid financing, more conservative than premium financing. I have a story from my past that I think is going to really, really help you and everybody to understand premium finance. 1983 is the first year I started in the investment business, and I met a 65-year-old widow whose husband had passed away 18 years before when she was 47. They had 5 children, and they had a 7,000-acre sheep ranch. The husband ran the sheep ranch. It was his business, and she was the homemaker of raising the kids. And now she's 47 when he passed away, and she took over the sheep ranch. Let's give you some numbers. The ranch value in 1983 was around $500 an acre, times 7,000, that's $3,500,000. 1983, the unified credit for not paying estate tax was $275,000. That's amazing how little it was. We're going to go over all those rules because that's important after we finish this story problem. At her death, her estate would owe estate tax on $3,225,000, the amount over $275,000. At a 40% estate tax rate, that'd be $1,290,000. Now, let me tell you a little bit about this lady. She lived conservatively, not an amazing house, a nice house. It was paid for. And her livelihood, her income was from the ranch. She made from the ranch about $50,000 a year, and she didn't have a lot of investments, very, very little. And so that's her situation. And where is she going to get if she died at that moment, her estate would have to pay $1,290,000. $1,290,000. Let's go through all the potential solutions or how she could handle this. Okay. First, she could pay the estate tax and pass on a smaller legacy to her heirs. Where would the money come from? She didn't have it. She had a $3.5 million sheep ranch. So if she chose that route, which is kind of the default route, she would have her estate would have to sell the ranch after she is gone. And you've heard the term fire sale. This would have been a fire sale. The people who would be up bidding for it would not be bidding $3,500,000. 10% less, 20% less. I don't know. Let's say $3,500,000. Let's say $2,500,000. Possible. So she sells it for $2,500,000. She pays the estate tax, and she has about $1,300,000 left. Not the end of the world. The federal government needs money to pay for their expenses. That's the estate tax. So here's some other solutions. Purchase life insurance and pay the premium. 25-year term is $17,000, and guaranteed universal life is $25,000. I like to show you a tool that's available for you to get numbers like that. It's on my website, so I'm going to change screens. Okay, now you can see my website. And I'm going to scroll down a little bit to this quick links. Now, over on the right, there's a quote and apply multi-carrier. Let's click on that. The insurance management organization I work with, this is their software program that they've designed for my benefit and others. And so here's how to get an insurance quote. You put in the name. I'm going to just put in a last name of A, and go next. And then you pick male or female. In this case, we're going to go female. Then you choose a health. They've got 5 hearts, and you're guessing on yourself. This person is 65-year-old, kind of a strong lady, but 65. I'm going to give her a second to the highest. Is that fair? Never smoked. And it says here I can skip putting in the weight, so I'm going to skip all that. But I do have to put in a birthday. I don't know her birthday, so I'm going to put January 1st. Oh, and let's see. Here we are on my calculator. Get my calculator working. 1 second. So 2024 subtract 65. That would put In this example, it should have been born in 1959 for that amount of years. So next, here we have all the different types of insurance. Term, all lifetime options, accumulation, index, universal life, whole life, final expenses, long-term care, guaranteed issue. But right for begin with, I'm going to put term. And it had 1 million already plugged in there. And it started calculating things, but we need insurance for 1,290,000. So I'm going to move this little thing up. Notice that here, it doesn't give me that option. We can get it more detail when you apply, but for my quote, I'm going to go 1,250,000, and it calculated term policies, 10, 15, 20, 25 years. She was 65, so we would, if we went with the 25-year term, that would take her to 90. So 1441 times 12 equals 17,292, and that's how I got that 17,000. I rounded it down. But let me go to this other options. I clicked on lifetime, and now we're getting all kinds of whole life, universal life, and it's for a 65-year-old in that particular health. They're calculating the amounts, but I want to do it with a guaranteed life, and we've already got a 1,250,000. So it came out with 2,113. Let's do that on my calculator. 2,113 times 12 equals 25,356. And that's how I got this. Anyway, this is a resource for you. You can get some ideas on what different levels of insurance cost. Okay, I'm going to go back to my other screen. And now you can see there's that 25,000 for 17,000 a year and guaranteed life for 25,000. So we could ask the lady, can you, we can cover your estate tax issue if you can buy this kind of policy. I'd recommend the guaranteed because that's going to take you through all ages, where the first one is only going to take you to 90. And if you live to 95, then we got a problem. So if she said, which she did, Jim, I don't have that 25,000. I only live on about 50. That's about what I make after expenses. Well, what she could have done, maybe, is she could have gone to her 5 children and said, hey, I got this estate tax. If you want the ranch after I'm gone, I got to buy this insurance. And would you pay your equal share, let's say 6,000 each? That'd be and then when I pass away, you got it. This person did not become a client back in 1983. I'll finish that story in a bit, but I pulled up for this presentation to see when, see if there was a obituary online, and there was. She actually lived 290, and so she'd have squeaked in on that 17,000, and it would have worked in that way. But there's that second option. The third option would be buy life insurance and finance the premiums. If the interest is 5%, that'd be 1,250 a year, quite a bit less. But you have to put up collateral, and it needs to be liquid collateral. And I'm going to show you all those rules in some other slides. And you could have paid just the interest, but then it'd be more interest after a second year and third year. It's best if you pay some of the premiums in premium finance. The fourth option, purchase life insurance and finance a portion. Just not finance the whole thing. Or here's another idea. Use the annual gift tax exclusion. And in 1983, it was $10,000 a year. Today it's 18. So what that means is you can give $10,000 to a person per year without paying a gift tax and without filing a gift tax form. So she has 5 children and they all have spouses. With just the 5 children and spouses, she could give away $100,000 a year. But to get the amount she needed, we'd have to do $130,000 a year. And I told you she'd have to 90, so we'd have to give some to some grandkids maybe. But so you can give away pieces of your estate every year. And when she finally crossed over 50%, maybe they could gang up on her and sell her ranch for her. So there's some disadvantages here. But until while she still owns 50%, she's in control. We know she lived to 90, but you don't know. So if you did this, you probably still need to buy some life insurance as you did this every year. Hope that made it through to your understand it. Another option would be to give the ranch to a charity, the whole thing. And the charity then sells it tax-free for their benefit. And you get in exchange a charitable gift annuity. And a gift annuity is you get an income for the rest of your life. And 5%, I think that's probably an okay number to use today. That would mean on $3,500,000, $175,000 a year. She doesn't need $175,000. She probably wants the ranch. But if she did this, she's eliminated her estate tax problem, gave it away, has plenty of income the rest of her life. And if she wanted to replace the $3,500,000 for her kids, not the ranch, but the equivalent, she could buy a guaranteed universal life for $71,000 a year. So subtract the $71,000 from 175, and she still has $100,000. So in the reality, I met with the 5 children in a big meeting, and I did encourage her to set up a trust account to get things moving along. But in the process, I was young in the investment business. I would call her and she wouldn't call me back. So I try to help. But I believe I showed her all these different options at the time, but I wasn't able to help. I don't know what actually happened with the ranch. Who knows? Oh well, I think that's a good example to show you how premium finance can work. Well, let's get my system working. Okay, now we're going to show you the current estate tax rules of today. Unlimited marital deduction allows spouses to transfer an unlimited amount of money to one another, including after death, without penalty or tax. This is if you own things in joint ownership with rights or survivorship, this is it. And if you own everything this way, and your spouse passes away, everything's in your name. It seems real clean. It seems easy. It is easy, but you haven't really solved potentially a future problem. So it's not always the best answer, but it is there. Annual gift tax exclusion. We talked about the sheep rancher at 10,000. Now it's 18,000 a year. So if your estate is over, well, you can now gift 18,000 a year per person. The unified credit is not 275,000 today. It's 13,610,000. We've gone up a whole lot. So if your estate is not over 13 million, I wouldn't consider premium finance. Premium finance is really to help you pay the estate tax. I wouldn't do it for a higher income, or I wouldn't use it for Kaizen strategies. I wouldn't do it. But so 13, and that means a couple can have two of those for 27 million. You can see that we're not using premium finance as much as we used to in today's day and age because the unified credit is so high. If your estate is over the amount, what is the tax? For the first 10,000 over the amount over that 13 million or 27 million is 18%. Then the next 10 to 20 is 20, and I've shown you four brackets, but there's 8 more, and a million plus is 40%. So that's why I also use the 40. That 40% has not changed since 1983. For the highest bracket, that's how much people are paying. So if your estate is over the 13, then you need to be really concerned about this. Here's an issue. There's a sunset clause December 31st, 2025. If congressional action is not taken, the exemption amount will revert to the 2017 levels of 5.6. And then if your estate is 20 billion, you've got an estate tax problem. Who will this affect? Well, I already told you. Individuals with an estate over 7 million will have to worry about estate taxes. Then I kind of gave an example of what this estate tax would be. We don't know whether Congress is going to pass it. We don't know who the president is going to be. We don't. This particular clause in this law was put in when Trump was the president. So, what are your options? These are kind of the same options I had for the sheep rancher. Let your estate pay the tax and pass on a smaller legacy. Give money to a charity instead of Uncle Sam to receive a deduction. Purchase life insurance, pay the premium. Purchase life insurance and finance the premiums. Purchase life insurance and finance a portion of premiums. More people are starting to be concerned because of this potential change. So, because of the current laws, this is what we have set up as our premium finance rules. We're not going to consider it unless people have a minimum net worth of 10 million. This will change if the sunset happens, but that's what we're currently doing. If we sell a whole lot more Kaizen, and this isn't a Kaizen webinar today, but it's the product I love. The minimum premiums on these policies of 10 million is going to be over 500,000 a year. This is not for the low estate families. Interest rates become higher as we go lower. So we're set these levels to protect people. Let's see, get my thing working again. And if you do qualify and you need premium finance, you got to have collateral. In real estate, you've heard location, location, location. Well, in financing is collateral, collateral, collateral. Funds must be in cash or cash equivalent. Equities, you don't get 100% credit for those, up to 70%. No privately held stocks, just public. Bonds are credited at 95%. Cash, maybe you'll just get some letter of credit. In my sheep rancher, if she did a premium finance, she didn't have the equities or bonds for collateral, so she would have to do a letter of credit. And letter of credit is no walk in the park either. The average cost per year is 1 to 3% of the collateral plus the cost of appraisal. Banks offering a letter of credit must have an A or better rating and backed by an A-rated bank. Assets would require for a letter of credit is this is where real estate comes into play, or art, jewelry, or gems, and the bank's willing to sign the letter of credit. If it's not renewed, you need the amount backup liquidity. You need to have the collateral. And this is also the area where there's been problems in premium finance. People think it's a catch-all, a fix-all, but the collateral has to be there or there's problems. Here's our rules of thumb. Clients should have 10% of their net worth liquid. Clients should not exceed 10% of net worth in collateral. We don't want them having 100% of their net worth collateralized. And clients should state that they will not need the collateral in a stressed environment. So you can see why we don't, today, we're not doing this in that many opportunities. Here's some averages of what's going on today. When we do sell a premium finance, the death benefit is usually 10 to 30 million. The premiums are usually 750,000 to 3 million a year. And whether they're paying all, well, let me jump ahead of there. It's way down there. It says 100% interest roll-up designs, no out-of-pocket. I mean, this is where you financing the whole premiums. This is where you need even more net worth, 20 to 50 million net worth and 5 million plus available in collateral. Usually in most premium financing, you're paying something. Notice that range of 0 to 20% of the planned annual premiums. And the leverage is usually about 10 to 1. So we're borrowing 10 million and we're paying $1 million a year for right in that area. Kaizen, for example, is also 3 to 1. That's why, and the way Kaizen is designed, you don't need any collateral. It's a different ball game than this premium finance. So if you want to pursue policy in this area, we need to know your net worth and what it's made up of. Just a whole net worth statement. We're going to notice which ones are liquid. You can state which ones are liquid, available for collateral, and what's the objective of pay the estate tax, or what are we doing this for? Have you thought about the need for estate planning? I'm a big fan of trusts. They've been good for my family when relatives have passed away. That's helped me. Anyway, Chris Finley is my estate planning attorney. This is a good place to start, getting your things in order. So if there's a sunset, then there will be lower numbers. I have no idea. So we're getting close to closing, but I'd like to just, it's not a Kaizen webinar today, but here's my 6 key features and advantages of Kaizen, because it is Premium Finance Junior. Life insurance, the proceeds are tax-free, and you can borrow from a policy tax-free. Number one, we'll eliminate tax risk. 2, we buy an index universal life policy, and not explaining the details, but there's 0 downside risk. You can't have a negative performance number, and yet you get market performance. That's number 3. So no downside. Number 3, you have good growth potential. You'll have capped indexes, which could average of 8.2 over 10 years, or you could have participating loans, and the participation rates are higher, 218 or even more, which is last 10 years, 11.88. Good performance, no downside. You have death benefit and living benefits. The living benefits, terminal, chronic, critical illness, critical injury, these are valuable today for every family. The normal eliminates financial vulnerability risk. And then we do leverage here, 3 to 1, without collateral, personal guarantees, loan documents, interest rate payments, or credit checks. Substantially reduces capital risk and gives you more money working. That's Kaizen's my bread and butter because of this. It's only 5 payments. There are some disadvantages that I like to kind of oftentimes close here. You have to qualify for life insurance. You must qualify as standard or better. If you're not in that area of health, you can't have Kaizen or premium finance. For Kaizen, you need to be between 18 and 65, and you need to be able to. They require certain net worths from 0 to $1 million, a whole lot less than premium finance, and income ranges from 100 to 400. You need to be able to pay the 5 annual payments. The minimums are 20 to 40,000. The average in our country out of every Kaizen sold is 70,000. And you need to be willing to leave this alone for 15 years. That might be the biggest requirement, leaving it alone. We live in a world where we want instant gratification in our investments too, and this is not an instant gratification investment. Well, there's your introduction to premium finance. If I didn't answer all the questions, I'm not going to take questions today, and I'm going to leave it just like that because it'd be more individual questions anyway. So if you have a question on premium finance or Kaizen, there's my office number, my mobile number, my email. Happy to help in any way. I hope you've enjoyed today, our webinar on premium finance. Have a good day. Bye.